Let me tell you something that most people on Wall Street will never understand. They think investing is about being smart. They think it is about having the best algorithms, the fastest computers, the most sophisticated models. They think it is about hiring the brightest minds from the most prestigious universities and putting them in rooms with Bloomberg terminals and Excel spreadsheets. But after 6 decades of watching fortunes made and lost, I can tell you with absolute certainty that the most important quality in investing has nothing to do with intelligence. It has everything to do with temperament. And right now, in 2026, my temperament is telling me something that I cannot ignore. People have been asking me for months now why Berkshire Hathaway has been systematically reducing its technology holdings. They see the headlines, they watch the talking heads on television speculating about what the Oracle of Omaha must be thinking. They read the quarterly filings and notice that our positions keep getting smaller. Some say I have lost my touch. Others claim I simply do not understand the new economy. A few have even suggested that at 95 years old, I should have hung up my investing hat long ago. But here's what they do not understand. I am not selling because I am scared. I am not selling because I do not appreciate what these technology companies have built. I am not selling because I think the world is ending or that the American economy is about to collapse. I am selling because the numbers no longer make sense. And in my world, when the numbers stop making sense, you stop writing checks. Let me take you back to the beginning, because to understand where we are going, you need to understand where we have been. In 1965, I took control of a failing textile mill in New Bedford, Massachusetts. The company was called Berkshire Hathaway, and at the time, most people thought I was crazy for getting involved with it. The textile business was dying. Everyone knew that. Foreign competition was destroying American manufacturers. The economics of the industry were brutal, with commodity products, price competition, and constant capital requirements just to stay even. But I saw something in that company that others missed. I saw a vehicle through which I could deploy capital in ways that would compound over decades. The textile operations themselves were never going to make us rich. That much was obvious from the start. But the cash flow from those operations, combined with the corporate structure of the company, gave me a platform from which to make investments that would change everything. That decision, which many considered foolish at the time, turned what was essentially a worthless enterprise into a trillion-dollar conglomerate. And the secret was never about predicting which industries would thrive or which technologies would emerge. The secret was always about paying the right price for quality businesses and then holding them for as long as the fundamentals justified that holding. I learned this philosophy from my mentor, Benjamin Graham, who taught me at Columbia Business School in the early 1950s. Ben was the father of value investing, and his book, The Intelligent Investor, changed my life. He taught me that investing is most intelligent when it is most businesslike. He taught me about margin of safety, the idea that you should always pay significantly less than what something is worth to protect yourself against errors in judgment and unforeseen circumstances. Most importantly, Ben taught me to separate price from value. Price is what you pay, value is what you get. They are not the same thing, though the market often treats them as though they are. A stock certificate is not just a piece of paper or a blip on a computer screen. It represents partial ownership in an actual business with real assets, real employees, real products, and real customers. The job of the investor is to figure out what that business is worth and then buy it only when the price is significantly below that worth. Now, when it comes to technology, I will be the first to admit that I was late to the party. Charlie Munger, my late partner and dear friend, and I both acknowledge that we made a significant mistake by not investing in Google when we had the chance. We could see in our own operations at Geico how effective Google advertising was. We were paying them $10 to $11 per click, and that money was generating real returns for us in the form of new insurance customers. The economics were obvious. The competitive advantage was clear. But we sat there sucking our thumbs, as Charlie liked to say, and watched one of the greatest businesses of our generation grow without us. That regret stayed with me for years. I would think about it late at night. I would kick myself for being too cautious, too stuck in my old ways of thinking. Here was a business that met every criterion I cared about. Strong competitive position, high returns on capital, recurring revenue, network effects that made the business stronger over time. And I missed it. So when we finally had the opportunity to invest in Apple back in 2016, I was determined not to make the same mistake twice. And let me tell you, Apple was everything I had been looking for. It was not just a technology company in the traditional sense. It was a consumer products company with the most loyal customer base on the planet. People did not just buy Apple products, they loved Apple products. They identified with the brand in ways that reminded me of companies like Coca-Cola and See's Candies, businesses I had owned and admired for decades. Think about what Apple had built. An ecosystem of devices and services that all worked together seamlessly, customers who upgraded their iPhones religiously every few years, a services business generating recurring revenue from music, storage, payments, and applications. A brand that commanded premium prices in every market around the world. This was not just a technology company. This was a consumer franchise. And the valuation? When we first started buying Apple shares, the stock was trading at roughly 10 times earnings. 10 times earnings for a company with Apple's brand power, cash generation, and growth prospects. That was a gift. That was the kind of opportunity that comes along once in a decade, and we took full advantage of it. Our investment team, led initially by Todd Combs and Ted Weschler, started accumulating shares. As the position grew and I became more comfortable with the business, I added to it personally. We kept buying quarter after quarter, building what would become the largest single position in Berkshire's history. Over the next several years, our Apple investment became one of the most successful in Berkshire's history. The position grew to be worth well over $100 billion at its peak. Apple became nearly half of our entire public equity portfolio. The returns were staggering. We were making more money on Apple in a single year than many investors make in their entire careers. It was a phenomenal success, and I am proud of what we accomplished. But here's the thing about investing that most people never learn. The price you pay determines your return, not the quality of the business, not the brilliance of management, not the size of the market opportunity, not the elegance of the technology. The price you pay. And the prices being paid for technology stocks today bear no resemblance to the prices that existed when we made our initial investments. Let me give you some context to understand what I mean. When we bought Apple in 2016, it was trading at a price-to-earnings ratio of around 10. Today, that same company trades at a multiple north of 35. The stock price has doubled since 2022, but the revenue has remained relatively flat. When you look at the fundamentals, at the actual cash being generated relative to the price being paid, the math simply does not support these valuations. Think about what that means in practical terms. When we bought at 10 times earnings, we were essentially saying we would recoup our investment through earnings alone in 10 years, assuming nothing changed. That seemed like a reasonable bet for a growing company with strong competitive advantages. But at 35 times earnings, you are saying you are willing to wait 35 years to get your money back from current earnings. That only works if earnings grow substantially. And while Apple is a wonderful company, it is not growing at the rates that would justify such a premium. And Apple is not unique. Across the technology sector, we are seeing valuations that make the dot-com bubble look reasonable by comparison. There is a measure that I have referenced over the years that some people call the Buffett Indicator. It compares the total value of all publicly traded stocks to the gross domestic product of the United States. I once said that this was probably the best single measure of where valuations stand at any given moment. The logic is simple. Stock prices ultimately have to be supported by economic activity. If the value of all stocks is massively higher than the actual output of the economy, something has to give. When that ratio is in the 70 to 80% range, buying stocks is likely to work very well for you. When it approaches 200%, you are playing with fire. I said that back in 2001, and I believe it is just as true today as of late 2025, that indicator reached 230%. That is the highest reading in recorded history. Let me say that again, because I want you to understand the significance. The Buffett Indicator is at the highest level ever recorded, higher than the peak of the dot-com bubble in 2000, higher than the housing bubble in 2007, higher than any previous moment of market euphoria in American history. Now, I want to be clear about something. I am not in the business of predicting market crashes. Nobody can time the market consistently, and anyone who tells you otherwise is either deluded or trying to sell you something. I have been wrong about timing many times in my career. I was concerned about valuations in the late 1990s, and the market continued rising for another 2 years before finally collapsing. Timing is not my game. What I can do is look at valuations and determine whether the prices being offered make sense given the likely returns. That is a fundamentally different exercise than predicting when prices will fall. I can tell you that at current valuations, future returns are likely to be disappointing. I cannot tell you whether that disappointment will come next month, next year, or 5 years from now. And right now, the prices do not make sense. This is why Berkshire's been a net seller of stocks for 12 consecutive quarters. This is why our cash position has grown to $382 billion, a record for our company. This is not because we have given up on investing. This is not because we do not want to put money to work. It is because we refuse to pay prices that virtually guarantee substandard returns. People sometimes ask me why we do not just sit on our existing positions and wait. The answer is that waiting while owning overpriced assets is not free. There is an opportunity cost. Every dollar tied up in an overpriced stock is a dollar that cannot be deployed elsewhere when better opportunities arise. And those opportunities do arise. They always do, though often when people least expect them. In 2008, during the financial crisis, we deployed billions of dollars into Goldman Sachs, General Electric, and other businesses at prices that seemed unimaginable just months earlier. We could only do that because we had liquidity. If our money had been tied up in overpriced securities, we would have missed those opportunities entirely. Think about it this way. If you buy a business at 40 times earnings, you are essentially saying that you are willing to wait 40 years to get your money back, assuming earnings stay flat. For that investment to work out well, you need earnings to grow substantially. But how much growth can you realistically expect from companies that already dominate their markets? Apple has over 1 billion active devices in use around the world. They have captured essentially everyone who is willing to pay premium prices for a smartphone. Where is the next billion customers going to come from? Are there 1 billion people sitting around waiting to spend $1,000 on a new phone who have not yet done so? The growth opportunities that existed 10 years ago simply do not exist in the same way today. Microsoft is embedded in virtually every corporation on the planet. Their Office suite and Azure cloud services are foundational to modern business operations. That is an extraordinary competitive position, but it is also a mature one. How much faster can Microsoft grow when they already have relationships with essentially every enterprise customer on Earth? Google handles 90% of all internet searches. YouTube is the dominant video platform. Android powers most of the world's smartphones. These are extraordinary businesses with extraordinary market positions, but they are also businesses operating at massive scale with limited room for the kind of explosive growth that would justify current valuations. The law of large numbers eventually catches up with everyone. When you are already generating $200 billion in annual revenue, you cannot grow at 30% per year for very long. The math simply does not work. Now, people will point to artificial intelligence as the next wave of growth. They will argue that the technology sector is on the verge of another revolution that will justify these valuations. AI will transform everything. AI will create trillions of dollars in new value. AI will make these companies more profitable than ever before. And they may be right about the revolution. I have seen enough change in my lifetime to know that predicting the future is a fool's errand. The automobile changed everything. The airplane changed everything. Television changed everything. The personal computer changed everything. The internet changed everything. I would be foolish to say that artificial intelligence will not also change everything. But here is what I also know. Even revolutionary technologies do not guarantee investment returns. The automobile revolutionized transportation, but most early automobile companies went bankrupt. The airplane revolutionized travel, but airline investors have collectively lost money over the history of the industry. The internet revolutionized communication, but most .com investors lost their shirts. It is not enough for technology to be transformative. The price you pay still matters. You can be absolutely right about the importance of a new technology and still lose money if you overpay for exposure to that technology. Think about the railroad boom of the 19th century. Railroads transformed American commerce. They connected cities, enabled trade, and created immense wealth for the nation as a whole. And yet, the vast majority of railroad investors lost everything. There were thousands of railroad companies, and most of them failed. Even the ones that survived often wiped out their shareholders multiple times through bankruptcy and restructuring. The lesson is clear. Revolutionary technology creates winners and losers. It does not guarantee profits for investors, especially investors who pay premium prices at the peak of enthusiasm. In 2025, Berkshire made a significant new investment in Alphabet, the parent company of Google. We purchased over 17 million shares worth approximately $4 billion. Some people saw this as a contradiction. How can I be bearish on technology while simultaneously buying one of the largest technology companies in the world? But there is no contradiction if you understand how I think about investing. Alphabet, at the time of our purchase, was trading at a price-to-earnings ratio of around 27. That is high by historical standards, but it is substantially lower than many of its peers. More importantly, Alphabet has genuine competitive advantages that are difficult to replicate. Google Search has an economic moat that may be as wide as any business I have ever seen. The network effects are enormous. The data advantages are unassailable. The brand is trusted by billions of people. The company generates enormous free cash flow. Unlike many technology companies that consume cash faster than they generate it, Alphabet produces rivers of cash that can be returned to shareholders or reinvested for growth. The balance sheet is pristine. The management team, while not perfect, is competent and experienced. And unlike some technology companies, Alphabet has real assets in its cloud computing infrastructure and its artificial intelligence capabilities. Google Cloud may not be the market leader, but it is a genuine competitor with differentiated offerings. The company's Gemini AI model is among the best in the world. These are not just stories. These are real businesses generating real returns. The investment was made at a price that gave us a reasonable margin of safety. That is the key distinction between the Alphabet purchase and a decision to continue holding overpriced positions in other companies. Meanwhile, we continued selling Apple throughout 2025. By the third quarter, we had reduced our position by another 15%. We sold approximately 42 million shares, generating more than $3 billion in proceeds. The stake that once represented nearly half our portfolio now represents closer to 20%, and I expect that number to continue declining if valuations remain elevated. Some investors have interpreted this selling as a vote of no confidence in Apple's future, but that is not how I see it at all. I still believe Apple is an extraordinary company. I still admire Tim Cook's leadership. I still own Apple products personally and expect to continue using them for as long as I am able. The issue is not the quality of the business. The issue is the price. When we first invested in Apple, we were buying a wonderful company at a fair price. Today, we would be buying that same wonderful company at a price that no longer makes mathematical sense, and that is not a trade I am willing to make. I have said many times that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But the corollary is equally important. It is never wise to buy even the most wonderful company at a price that ignores fundamental economics. There is another factor that has influenced our decision-making, and it is one that I have discussed publicly at shareholder meetings. Taxes. The current corporate tax rate in America is 21%. That is the lowest rate in my lifetime. I remember when the corporate tax rate was 52%. I remember when it was 35%. I remember debates about whether rates should be higher or lower, but I have never seen them as low as they are today. The current rate is historically anomalous, and I believe there is a reasonable probability that it will increase in the future. Given the federal deficit and the national debt, some form of revenue increase seems inevitable. Whether that comes through higher corporate taxes, higher capital gains taxes, or some other mechanism, I cannot say. Politicians make promises and break them with equal frequency. Predicting what Washington will do is even harder than predicting what the market will do. But I would rather realize gains at a 21% tax rate than wait and potentially face a 28% rate or higher. If we sell Apple shares today, we pay approximately $29 in taxes for every $100 of profit. If the rate goes to 28%, we would pay an additional $7. On billions of dollars of gains, that is not a trivial amount. This is simply prudent tax planning. It is not a prediction about what Washington will do. It is an acknowledgement that the current rate represents an opportunity that may not last forever. When you have substantial unrealized gains and a reasonable expectation that tax rates may rise, it makes sense to accelerate the realization of those gains. Now, let me address something that I know is on many people's minds. My transition out of the chief executive role at Berkshire, in May of 2025, I announced that I would be stepping down as CEO at the end of the year. Greg Abel, who has been the vice chairman of our non-insurance operations, will take over as the new leader of Berkshire Hathaway. I will remain as chairman, but the day-to-day management of the company will be Greg's responsibility. This decision was a long time coming. I am 95 years old. I move more slowly than I used to. My hearing is not what it was. While I believe my mind is still sharp, I am under no illusions about the natural effects of aging. Greg at 62 has the energy and stamina to lead Berkshire through the next several decades. I do not. Greg has been with Berkshire since 1999. He started at Mid-American Energy, which became Berkshire Hathaway Energy, and worked his way up through the organization. He understands our businesses better than I do in many respects. He knows the managers, he knows the operations, he knows where the bodies are buried, as they say. More importantly, Greg shares my philosophy about capital allocation and business management. He is not going to come in and try to transform Berkshire into something it is not. He is not going to chase trendy acquisitions or make splashy deals to generate headlines. He is going to do exactly what I have been doing for 60 years, which is to deploy capital intelligently and let our businesses compound over time. Charlie Munger, who knew Greg well and worked closely with him for years, once said that Greg was a better business executive than I was in certain important ways. That was high praise coming from Charlie, who was not given to flattery. Charlie saw in Greg the same qualities that I see: integrity, work ethic, sound judgment, the ability to act decisively when circumstances require. Some people have speculated that our selling activity is somehow related to this transition. They suggest that I am cleaning house or simplifying the portfolio before handing over the reins. There may be some truth to that. I do want to leave Greg with maximum flexibility to deploy capital as he sees fit. A portfolio concentrated in overpriced stocks would limit his options, but the more fundamental truth is that I would be selling these stocks regardless of who was running Berkshire. The valuations simply do not make sense. And I have never been willing to sacrifice sound investment principles for any reason, whether personal convenience, public relations, or anything else. Let me tell you a story that illustrates how I think about these situations. In 2005, Berkshire's cash position as a percentage of total assets reached roughly 25%. At the time, many observers criticized me for holding so much dry powder. The market was rising, technology stocks were recovering from the dot-com bust, real estate was booming, interest rates were low. Everyone was making money. Why was the Oracle of Omaha sitting on the sidelines? Did I not see the opportunities around me? Was I losing my edge? Had I become too cautious in my old age? 2 years later, the financial crisis began. The housing bubble burst. The banking system nearly collapsed. Bear Stearns failed, Lehman Brothers failed, AIG required a government bailout. The stock market fell by more than 50% from its peak. Portfolios that had been built on leverage and optimism were destroyed. And Berkshire, with its massive cash reserves, was positioned to capitalize on the chaos. We made deals with Goldman Sachs, extending them a lifeline in exchange for preferred stock with a 10% dividend and warrants to purchase common stock at attractive prices. We did similar deals with General Electric and other quality companies that needed capital when no one else was willing to provide it. We bought common stocks at prices that would have been inconceivable just months earlier. Those investments generated billions in returns. The Goldman Sachs deal alone was worth over $3 billion in profit. Our patience was rewarded because we had the resources to act when everyone else was panicking. I am not predicting that the same thing will happen again. As I said, I do not pretend to know what the market will do in the short term. Maybe prices will continue rising for years. Maybe the skeptics will be proven wrong once again. Maybe this time really is different. But I can tell you that having cash available when opportunities arise is infinitely preferable to being fully invested when prices no longer make sense. When the opportunity comes, and it always eventually comes, I want Berkshire to be ready. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. That statement is not just a clever aphorism I trot out for shareholder meetings. It is a practical guide for capital allocation. And right now, the greed in certain sectors of the market is palpable. Look at the behavior of retail investors. Look at the enthusiasm for speculative assets. Look at the options trading volumes. Look at the margin debt levels, which have climbed to levels that historically precede market corrections. Look at the price to sales ratios, which have reached levels never before seen in market history. All of these indicators suggest that we are in a period of extraordinary speculation. Does that mean the market will crash tomorrow? No. Markets can remain irrational far longer than most people expect. The dot-com bubble took years to fully deflate. The market peaked in March of 2000 and did not bottom until October of 2002. That is 2.5 years of grinding losses with periodic rallies that convinced people the worst was over, only to be followed by further declines. The housing bubble continued inflating long after the warning signs were obvious. I wrote about the dangers of mortgage derivatives in our annual letter years before the crisis actually hit. The market ignored those warnings and continued partying until the music finally stopped. Momentum can carry prices far beyond what fundamental analysis would suggest. Fear of missing out is a powerful force. When your neighbor is getting rich from speculative investments and you are sitting on the sidelines, it takes tremendous discipline to stay the course. Most people cannot maintain that discipline indefinitely, but eventually, arithmetic wins. Stocks cannot outperform businesses indefinitely. If you pay too much for a stream of future earnings, your returns will suffer. There is no way around this basic mathematical truth. You can delay the reckoning, but you cannot avoid it forever. Now, I want to spend some time talking about why I remain optimistic about America, even as I express caution about current valuations. In the 20th century, the United States endured 2 world wars. We lost hundreds of thousands of young men on battlefields around the world. We survived the Great Depression, when unemployment reached 25% and bread lines stretched around city blocks. We weathered a dozen recessions and financial panics, each of which seemed catastrophic at the time. We experienced oil shocks that caused gas lines and economic disruption. A flu epidemic killed hundreds of thousands of Americans. A president resigned in disgrace. Through all of that turmoil, the Dow Jones Industrial Average rose from 66 to over 11,000. An investor who bought and held American stocks through all of that chaos would have earned returns that far exceeded any other asset class. The 21st century has already brought its own challenges. The September 11th attacks shook the nation to its core. The financial crisis threatened to collapse the global banking system. A pandemic killed millions and shut down economies around the world. Political polarization that would have been unimaginable in my youth has divided communities and families, and yet the American economy continues to grow. American businesses continue to innovate. American workers continue to create value. The entrepreneurial spirit that has always defined this country remains alive and well. I have never bet against America, and I never will. My caution about valuations should not be confused with pessimism about the future. I am extraordinarily bullish on the long-term prospects of this country. The system of capitalism that we have developed, for all its flaws, remains the most powerful engine for wealth creation in human history. No other system has lifted so many people out of poverty. No other system has generated so much innovation and progress. But acknowledging these positive fundamentals does not mean I should ignore prices, quite the opposite. Because I believe in America's future, I want to make sure that I am buying exposure to that future at prices that make sense. Overpaying for even the best businesses is still overpaying. The returns you earn are determined by the price you pay, not by the quality of the underlying asset. Let me also address the question of technology specifically. I have been accused throughout my career of not understanding technology. And there is some truth to that accusation. I am not a programmer. I cannot build a computer. I do not fully comprehend how artificial intelligence works at a technical level. When people start talking about neural networks and machine learning algorithms, my eyes glaze over much like everyone else's. But here is what I do understand. I understand competitive advantage. I understand cash flow. I understand the difference between a business with pricing power and a business without it. I understand human behavior and how it drives consumer decisions. I understand the importance of recurring revenue and customer lock-in. And when I look at the technology sector today, I see some businesses that possess durable competitive advantages and many more that do not. I see some companies generating real profits and many more that are burning cash in pursuit of growth that may never materialize. I see some executives focused on building long-term value and many more focused on the next quarter's numbers or their stock options vesting schedule. The companies that will succeed over the next several decades are those that have genuine moats around their businesses. They have something, whether a brand, a network effect, a cost advantage, or proprietary technology that makes it difficult for competitors to take away their customers. These moats are not always obvious. They do not show up on balance sheets, but they are the most important determinant of long-term business success. Apple has that moat. The ecosystem of devices and services creates switching costs that keep customers coming back. Once you have your photos in iCloud, your music in Apple Music, your apps on your iPhone, and your messages in iMessage, switching to Android is a major inconvenience. That is a powerful competitive advantage. Google has that moat. The dominance of search creates a flywheel effect where more users generate more data, which improves the algorithm, which attracts more users. YouTube benefits from similar network effects. The content library grows as more creators join, which attracts more viewers, which attracts more creators. Breaking that cycle would require an extraordinary effort by competitors. Amazon has elements of that moat. The logistics network they have built is essentially impossible to replicate. The Prime membership creates recurring revenue and increases customer loyalty. Third-party sellers depend on Amazon's platform, giving the company leverage in negotiations. Microsoft has that moat. The Office suite is embedded in virtually every corporate workflow. Training employees on new software is expensive and disruptive. IT departments prefer standardization over experimentation. These factors create enormous switching costs. But many technology companies that are currently being valued at extraordinary multiples do not have durable competitive advantages. They have a product that is hot right now. They have growth that looks impressive on a spreadsheet. They have management teams that are skilled at telling compelling stories to investors. None of that is the same as having a moat. When the tide goes out, and it always eventually goes out, we will discover who has been swimming naked. That was true during the dot-com bust, when companies that had been valued at billions turned out to be worth nothing. It was true during the financial crisis, when highly leveraged institutions collapsed seemingly overnight, and it will be true in whatever correction lies ahead. My job, and now Greg's job, is to make sure that Berkshire is not among those caught exposed. This brings me to a question that I am often asked. What should individual investors do in the current environment? My answer is the same as it has always been. Do not try to time the market. Do not panic and sell everything. Do not assume that because I am selling, you should be selling too. Your situation is different from Berkshire's situation. You have different time horizons, different tax considerations, different liquidity needs, different risk tolerances. What makes sense for a $1 trillion conglomerate may not make sense for someone saving for retirement or their children's education. What I can tell you is that the principles of sound investing remain unchanged regardless of market conditions. Buy good businesses at fair prices, hold them for the long term, ignore the noise. Do not let fear or greed drive your decisions. If you follow those principles consistently over decades, you will do fine, regardless of what happens in the short term. The market will go up and down. There will be periods of euphoria and periods of despair. And through all of it, the underlying value of good businesses will continue to grow, and patient shareholders will be rewarded. For most investors, the best approach is probably to buy a low-cost index fund and add to it regularly over time, regardless of market conditions. Do not try to pick individual stocks. Do not try to time your purchases. Just buy regularly and hold forever. This is not an exciting strategy, but it works. It has always worked, and it will continue to work. For Berkshire specifically, our strategy is straightforward. We will continue holding businesses that we believe have durable competitive advantages, even if short-term prices fluctuate. We will continue deploying capital when we find opportunities that meet our criteria. We will continue building cash reserves when those opportunities are scarce. And we will continue to act as owners of the businesses in which we invest, not as speculators hoping to flip stocks for a quick profit. That is a fundamentally different mindset. Speculators focus on price. Owners focus on value. Speculators worry about what the market will do tomorrow. Owners worry about what the business will do over the next decade. One thing that concerns me about the current market environment is the prevalence of what I would call investment gimmicks. Special purpose acquisition companies that allow promoters to take companies public without the scrutiny of traditional IPOs, meme stocks that rise and fall based on social media sentiment rather than business fundamentals, cryptocurrency speculation that makes the tulip mania of the 17th century look rational by comparison, options trading by retail investors who do not understand the risks they are taking. None of this is new, really. Every generation has its own version of tulip mania. Every bull market breeds its own crop of promoters and charlatans. The names change, but the underlying dynamics remain the same. People want to get rich quickly. They see others making money, and they want to join the party. They convince themselves that this time is different, that the old rules no longer apply, that a new paradigm has emerged. And then the bubble bursts, and they learn the same painful lessons that their parents and grandparents learned before them. Easy money is not easy. Get-rich-quick schemes do not work. There are no shortcuts to building lasting wealth. I have no ability to prevent this cycle from repeating. Human nature is what it is. Greed and fear will drive markets as long as markets exist. But I can refuse to participate in the madness. I can stick to principles that have served me well for 60 years. And I can sleep soundly at night knowing that Berkshire's capital is deployed in ways that make fundamental sense. Let me close with something personal. I have been extraordinarily lucky in my life. Lucky to be born in America at a time when this country offered unlimited opportunity. Lucky to be born male at a time when gender determined so much of what a person could achieve. Lucky to have parents who encouraged my interests and supported my ambitions. Lucky to find mentors like Ben Graham who taught me how to think about investing. Lucky to partner with Charlie Munger for nearly half a century. Lucky to lead a company with the most loyal shareholders in the world. At 95 years old, I am under no illusions about how much time I have left. The actuarial tables are not in my favor. I have lived longer than most people and longer than I ever expected. But whatever time remains, I intend to spend it doing what I love, which is thinking about capital allocation and trying to make good decisions for Berkshire shareholders. The technology investments that we have made over the years have been enormously successful. Apple alone generated returns that exceeded $100 billion. That success was built on the same principles that guided every other successful investment I have ever made. Buy good businesses at fair prices. Be patient. Let compounding work its magic. Do not let emotions drive decisions. The decision to reduce those positions is also built on the same principles. When prices no longer justify continued ownership, it is time to sell. Not because the business has deteriorated, not because we have lost faith in management, not because we think the technology is becoming obsolete, simply because the price has risen beyond what the fundamentals can support. This is not complicated, it is arithmetic. And in investing, arithmetic always wins in the end. You can delay the math, you can ignore the math, you can pretend the math does not apply to you, but eventually the math catches up with everyone. To everyone watching this, whether you are a Berkshire shareholder or simply someone interested in learning about investing, I would leave you with this thought. The most important decision you will ever make as an investor is deciding what you are willing to pay for $1 of earnings. Get that decision right, and everything else falls into place. Get it wrong, and no amount of analytical sophistication will save you. Right now, for technology stocks, the prices being demanded are simply too high. That is why we are selling. That is why our cash position has grown. That is why I am passing the baton to Greg with more dry powder than Berkshire has ever had. The opportunities will come. They always do. Sometimes they come suddenly in the midst of crisis, when everyone is panicking and no one wants to commit capital. Sometimes they come gradually, as market enthusiasm fades and prices slowly drift back toward rational levels. The timing is unpredictable. The arrival is inevitable. And when those opportunities arrive, we will be ready. We will have the capital to act. We will have the judgment to identify the best values. We will have the temperament to pull the trigger when others are paralyzed by fear. Until then, we wait patiently, confidently, knowing that the principles that guided us for 6 decades will continue to guide us for the decades to come. Thank you for your trust. Thank you for your patience. And thank you for being part of the Berkshire Hathaway family. The road ahead will bring challenges. It always does. But I have never been more confident in our ability to meet those challenges and emerge stronger on the other side. That is the Warren Buffett way. It has always been the Warren Buffett way. And under Greg Abel's leadership, it will continue to be the Berkshire Hathaway way for generations to come. Remember, be fearful when others are greedy, and be greedy only when others are fearful. Right now, the market is greedy, so we are being fearful. But that fear is not weakness. It is wisdom, it is discipline, it is the foundation upon which lasting wealth is built. Stay patient, stay focused, and never forget that the best investments are often the ones you do not make. Now, before I finish, let me share some additional thoughts that I believe are important for anyone trying to understand what is happening in the markets today. The rise of passive investing has fundamentally changed how markets function. When I started my career, stocks were priced by individuals and institutions making careful judgments about the value of individual businesses. Today, trillions of dollars flow automatically into index funds, buying stocks simply because they are in an index, without any regard for whether those stocks are fairly valued. This is not necessarily a bad thing for most investors. As I mentioned earlier, buying a low-cost index fund is probably the best strategy for most people. But the mechanical nature of these flows has created distortions in pricing that would not have existed in an earlier era. The biggest stocks get bigger simply because they are big. Capital flows into them regardless of whether their prices make sense. This dynamic has particularly benefited technology companies, which now dominate the major indices. Apple, Microsoft, Alphabet, Amazon, Nvidia, and a handful of other tech giants make up an enormous percentage of the total market capitalization of the S&P 500. When money flows into index funds, a disproportionate amount goes into these stocks, pushing their prices ever higher. This creates a feedback loop that can persist for a surprisingly long time. Rising prices attract more capital pushes prices higher still. The momentum feeds on itself until something breaks the cycle. What breaks the cycle is usually disappointing earnings. Eventually, companies have to justify their valuations with actual profits. When the profits do not materialize, or when they fall short of expectations, the momentum reverses. The same dynamics that push prices up begin pushing them down. I have seen this movie before. I saw it in the late 1960s with the Nifty 50 stocks. I saw it in the late 1990s with the dot-com bubble. I saw it in 2007 and 2008 with financial stocks. The details change, but the plot remains the same. Another factor that concerns me is the role of leverage in the current market. Margin debt has reached levels that historically precede significant market corrections. When investors borrow money to buy stocks, they amplify both their gains and their losses. On the way up, leverage makes everyone look like a genius. On the way down, it can be devastating. The danger of leverage is that it forces selling at exactly the wrong time. When prices fall, leveraged investors receive margin calls. They have to sell stocks to meet those calls, which pushes prices down further, which triggers more margin calls. This cascade effect can turn an ordinary correction into a devastating crash. The financial crisis of 2008 was amplified enormously by leverage. Banks and investment firms had borrowed money to buy mortgage-backed securities. When those securities started to fall in value, the forced selling created a death spiral that nearly brought down the entire global financial system. I am not suggesting that we are on the verge of another financial crisis. The banking system is much better capitalized than it was in 2008. Regulations have reduced some of the most dangerous forms of leverage, but there is still plenty of leverage in the system, and it will amplify whatever correction eventually comes. Let me also say something about the psychology of investing, because this is ultimately what determines most people's results. The hardest thing about investing is not doing the analysis. The hardest thing is controlling your emotions. Fear and greed are powerful forces, and they can override even the best laid plans. When markets are rising and everyone around you is making money, it takes tremendous discipline to remain cautious. You feel like a fool for sitting on the sidelines while your neighbors are getting rich. The temptation to join the party is almost irresistible. Conversely, when markets are falling and everyone is panicking, it takes tremendous courage to buy. Every instinct tells you to sell to protect what you have, to wait until things calm down before committing more capital. But those periods of panic are precisely when the best opportunities present themselves. This is why I say that temperament is more important than intelligence. A smart person with poor temperament will make poor decisions at critical moments. An average person with good temperament will make sound decisions consistently over time. The consistent decision maker will win in the long run. I have tried to cultivate good temperament throughout my career. I have tried to remain calm when markets are euphoric and optimistic when markets are depressed. I have not always succeeded. There have been moments when fear or greed got the better of me. But I have learned from those mistakes and tried to do better the next time. One technique that has helped me is to focus on the business rather than the stock price. When I own shares in a company, I try to think of myself as a part owner of that business. I ask myself whether I would be happy to own the entire company at the current price. If the answer is no, then I probably should not own the stock either. This perspective helps me ignore the daily fluctuations in stock prices, which are mostly noise. Over any single day or week or month, stock prices are driven by sentiment, by capital flows, by technical factors that have nothing to do with the underlying value of the business. It is only over longer periods that prices tend to reflect fundamental value. Another technique that has served me well is to have a clear investment philosophy and to stick with it regardless of what the market is doing. My philosophy is simple. Buy wonderful businesses at fair prices, hold them for the long term, let compounding do the work. This philosophy does not work in every market environment. In raging bull markets, more aggressive strategies will generate higher returns. But over full market cycles, including both bulls and bears, a conservative value approach tends to outperform. And more importantly, it allows me to sleep at night, which is not something to be undervalued. Speaking of sleep, let me tell you about the importance of staying within your circle of competence. Every investor has areas where they have genuine expertise and areas where they are essentially guessing. The key to success is knowing the difference. You do not need to be an expert in everything. You just need to be expert in something and to restrict your investments to that area. For me, my circle of competence includes consumer products companies with strong brands. It includes insurance companies, which I understand deeply after decades of owning Geico and other insurers. It includes railroads and utilities, which are straightforward. Businesses with predictable cash flows. It includes certain financial services companies with durable competitive advantages. My circle of competence does not include cutting-edge technology companies developing products I do not understand. It does not include biotechnology firms pursuing cures for diseases I cannot evaluate. It does not include complex financial instruments whose risks are difficult to assess. When I stay within my circle of competence, I make good decisions. When I venture outside it, I often make mistakes. The Apple investment was actually a departure from my usual practice, but I had the benefit of excellent managers in Todd and Ted who understood the technology better than I did. And more importantly, I viewed Apple as a consumer products company rather than a pure technology company. For individual investors, the lesson is to know what you know and know what you do not know. If you understand a particular industry because you work in it, that industry might be within your circle of competence. If you are fascinated by a new technology but do not really understand how it works or how the company makes money, that is probably outside your circle. There is no shame in admitting ignorance. I have spent decades telling people that I do not understand technology. That admission has saved me from many disasters. The dot-com investors who thought they understood technology when they actually did not were the ones who lost everything. Let me also share some thoughts about the importance of reading and continuous learning. I have spent most of my life reading annual reports, trade publications, newspapers, books about business, investing, and history and biography. Reading is how I learn about companies and industries. It is how I stay informed about changes in the economy. It is how I continue to improve as an investor even after 6 decades of practice. I encourage everyone to read as much as they can, not just investment books though. Those are valuable. Read about history to understand how past economic events unfolded. Read biographies of successful business leaders to understand what makes them tick. Read newspapers and magazines to stay current on developments in the world. The more you read, the more connections you can make between disparate pieces of information. You start to see patterns that others miss. You develop better intuition about which businesses are likely to succeed and which are likely to fail. Charlie Munger used to say that he was not really an investor, but a collector of mental models. He had models from physics and biology and psychology and economics, and he would apply them to investment problems. This multidisciplinary approach gave him insights that pure financial analysts often missed. I have tried to follow Charlie's example in my own way. I may not have his breadth of knowledge, but I have tried to learn from every source I can find. The investment landscape is always changing, and the only way to stay competitive is to keep learning. Finally, let me say something about legacy. At 95 years old, I think about legacy more than I used to. What will I leave behind when I am gone? What will Berkshire become after I am no longer involved? The honest answer is that I do not know. No one can predict the future with certainty. But I have done everything I can to set Berkshire up for continued success. I have chosen a successor in Greg Abel who shares my values and my approach. I have created a culture that emphasizes integrity, long-term thinking, and shareholder orientation. I have built a collection of businesses that generate enormous cash flow and have durable competitive advantages. Will Berkshire be as successful in the next 60 years as it was in the last 60? That depends on many factors, including some that are beyond anyone's control. But I believe the foundation is solid. I believe the principles are sound. And I believe that patient, disciplined investors will continue to be rewarded. My hope is that people will remember me, not just for the returns we generated, but for the way we generated them. We built Berkshire by treating shareholders as partners, by being honest about our mistakes, by refusing to cut corners or take shortcuts. We showed that you can be successful in business while still maintaining your integrity. If that approach to business and investing survives after I am gone, I will consider my life well spent. So that is why I have moved out of technology stocks. Not because I fear the future, not because I have given up on America, not because I think these are bad businesses, but because the prices no longer make sense. Because I would rather hold cash earning 4% than stocks priced to deliver disappointing returns. Because I want Berkshire to be ready when the opportunities inevitably arrive. This is the Warren Buffett approach. It has served us well for 6 decades. It will continue to serve us well for decades to come. Thank you for listening. And remember, the stock market is a device for transferring money from the impatient to the patient. Be patient.